Welcome to Government Accounting Basics. Today, we're going to discover what makes government accounting unique and why it matters. Our first objective is to explore how government accounting is different from for-profit accounting, which you might be more familiar with. Then we'll look at the special characteristics that define government accounting itself. By the end, you'll see how these differences impact the way governments manage money and serve people, all through clear examples and easy-to-understand comparisons. Let's start with our first objective, understanding how government accounting stands apart from for-profit accounting. Businesses focus on making money, but governments focus on using resources responsibly for the public good. This shift in perspective shapes everything about their financial management. Here's the core difference. For-profit businesses ask, did we make money? Their success is measured by growing profits and wealth, with a focus on revenue minus expenses. In contrast, government accounting asks, did we serve the public responsibly? It measures success by accountability. Did taxpayer money go where it was supposed to? Staying within budget and delivering services is the true mark of achievement in government finance. Let's take a closer look at how a business like Apple operates to understand the for-profit mindset. Imagine Apple sells an iPhone for $1,000. It costs $600 to manufacture that phone, which means Apple earns a $400 profit on each sale. For companies like Apple, success is all about making money for shareholders. Every decision, from product design to marketing, is aimed at increasing profits and growing the company's wealth. The digital icons and world map in this scene highlight how businesses operate on a global scale, always seeking new markets and opportunities to maximize earnings. In for-profit accounting, profit is the ultimate measure of achievement. Now let's look at a city government like Vancouver. It collects $1 million in taxes and spends that same amount on roads, police, and schools. There's no profit, and that's actually a good thing. Success here means providing essential services within budget. Remember, governments aren't supposed to make a profit. Their job is to break even while serving citizens. That's why accountability is at the heart of government finance. Now, let's highlight 5 major differences that set government accounting apart from business accounting. First, what do they measure? Businesses focus on profit, while governments measure service and accountability. Second, the role of the budget is central in government. It's a legal limit, not just a plan. Third, fund accounting, sometimes called the envelope system, helps governments track money for specific purposes. Fourth, timing matters. When money is counted can differ. Finally, financial statements look different, reflecting these unique priorities. Let's start with what businesses and governments actually measure. For a business, the main question is, how much profit did we make? Their financial statements focus on showing profit or loss, and the ultimate goal is maximizing shareholder wealth. In contrast, government accounting asks, did we spend money on what we promised? Instead of focusing on profit, governments track whether they followed the budget and delivered public services as planned. Their reports show if funds were used as intended, making accountability to the public their top priority. Now, let's talk about budgets. In business, a budget is more like a flexible target. If a great opportunity comes up, companies might spend more than planned, like going over budget on marketing if sales are booming. But for governments, the budget is literally the law. They can't spend more than what's approved, even in emergencies, without official permission. For example, while a business might buy new equipment when profits are high, a city can't purchase a new fire truck unless the council votes to approve it, even if it's urgent. Here's where fund accounting comes in. Think of a business like Apple. It has one big pot of money that can be spent on anything from research to dividends. Governments, on the other hand, use separate envelopes or funds, one for daily operations, another strictly for roads, and others for special projects or water services. To make this relatable, imagine your own budget at home. You might have envelopes for rent, groceries, and entertainment. Even if rent is short, you can't just grab from groceries without talking it over first. That's how governments keep spending disciplined and transparent. Let's look at when money officially counts. In business, accrual accounting means recording revenue when it's earned, even if the cash comes later, and expenses when they're incurred. For example, selling an iPhone in December but getting paid in January, the sale is recorded in December. Governments often use modified accrual or cash methods, recording transactions when cash actually moves. So if police cars are ordered in December but paid for in January, the expense might show up in January. Why? Businesses care about profit timing. Governments care about sticking to their cash budget. Business and government financial reports look very different. Businesses prepare income statements, balance sheets, and cash flow statements to track profitability and financial health. Governments focus on reports like budget versus actual, which shows if they stayed within their spending plan, alongside balance sheets by fund and detailed notes. For instance, if $50 million was budgeted for education but only $48 million was spent, that $2 million under budget is seen as a success. The spotlight is always on how closely actual spending matches the approved budget. To wrap up this section, let's highlight key characteristics of government accounting. It's all about ensuring transparency and accountability, tracking not just how much was spent, but whether funds were used for their intended purpose. Professionals work together using digital tools to analyze data and support informed decisions. This approach helps build public trust and keeps everyone focused on providing essential services within the limits of approved budgets. Let's start by exploring what makes government accounting unique. First and foremost, accountability is at the heart of the process. Governments must show exactly how public funds are managed. Unlike businesses, the focus isn't on profit, but on balancing assets and liabilities to maintain a stable net position. The budget acts as the key guiding document, shaping all financial decisions. Interestingly, there's no direct link between revenues and expenses, nor between voter satisfaction and financial results. The main goal is simply to break even and provide services. Also, government accounting keeps things consistent, with no separation between internal and external reporting. To really understand government accounting, it helps to see how governments differ from nonprofits and for-profit businesses. Governments are publicly owned and controlled by voters. Their main goal? Service, delivering benefits to the community, not chasing profit. They report to the public, and their success is measured by the impact they have. Nonprofits, on the other hand, are mission-driven, controlled by boards, and answer to donors. For-profits are privately owned, focused on making money for shareholders, and measure success through financial returns. Governments actually prepare two distinct sets of financial statements, a bit like keeping both a detailed monthly budget and a big-picture annual summary. Fund financial statements break down each pot of money, just as you might track spending in separate envelopes for rent, groceries, or entertainment. Meanwhile, government-wide financial statements pull everything together for a full financial snapshot, like your annual tax return totals. This dual reporting model helps ensure both detailed accountability and a clear view of overall financial health. This diagram maps out how government financial reports are structured. At the left side are government-wide financial statements, which summarize all governmental and business-type activities for the primary government. The right side are fund financial statements, divided into governmental funds, proprietary funds, and fiduciary funds, each serving different purposes, like tracking general operations, business-like services, or managing resources held in trust. Arrows show how information from these various funds rolls up into the overall picture. There's also a spot for discretely presented component units. Think of them as related organizations whose finances need to be reported separately. So what's the key difference between these two types of statements? Fund financial statements focus on how each fund was managed during the year, almost like checking if you followed your envelope budgets. The emphasis is on short-term accountability. Did we follow the rules for each pot of money? In contrast, government-wide financial statements look at the city's overall worth and long-term health, much like a business's total assets and debts. The big question here is the city financially healthy overall? Let's wrap up with some key technical differences. Fund financial statements use modified accrual accounting, focusing on current resources and short-term results. Think one-year snapshots with only current assets shown. Depreciation and long-term debt usually aren't included. In contrast, government-wide statements use full accrual accounting, just like businesses. So they show all assets, including buildings, factor in depreciation, list all debts, and present a comprehensive view over time. While funds require multiple reports for each type, government-wide statements boil it down to two main reports focused on overall financial health. Let's wrap up with a big picture comparison. Fund financial statements are like using monthly budget envelopes. They focus on individual funds, track this year's money, and ask, did we follow the rules? These are mainly for managers and auditors to ensure legal compliance. On the other hand, government-wide statements are like your annual tax return or net worth snapshot. They show the entire government's long-term financial health and answer, are we financially healthy? These are especially useful for investors, citizens, and analysts who want to see the bigger picture. Modified accrual accounting is the hybrid method used for most government funds. Think of it as regular accrual accounting, but tweaked for government needs. For revenues, you only count them if you know exactly how much you'll get and if the cash will arrive soon, usually within 60 days. For expenditures, you record them when the obligation arises, much like full accrual. In simple terms, revenue rules are stricter. You need to have the cash coming soon, while expenses are counted as soon as they're owed. This helps governments stay transparent and manage cash flow responsibly. Governmental funds come in several main categories, each with a specific purpose. The general fund is like the main checking account for everyday operations. Special revenue funds are set aside for particular uses, such as road repairs or public safety. Capital projects funds are used when building new facilities, while debt service funds handle paying back loans and bonds. Permanent funds act like endowments, money that can't be spent, only invested to generate income for a specific cause. These fund types help ensure that money is used exactly as intended. Now let's look at proprietary funds, which operate more like businesses within government. These funds cover services that charge fees, such as water utilities, airports, or golf courses. These are called enterprise funds. Internal service funds work behind the scenes, providing support like vehicle maintenance or IT services to other departments. By managing these activities separately, governments can track costs and performance just like a business would. Fiduciary funds are all about holding money on behalf of others. This isn't government money, it belongs to someone else. Pension trust funds manage retirement savings for employees, while agency funds temporarily collect money, like taxes, that will be passed along to another government entity. These funds make sure that resources meant for others are handled with care and accountability. There are some key rules that set fund accounting apart. First, money usually can't move between funds. Each fund is its own piggy bank, and transfers require special approval. Second, every fund must balance. You can't spend more than what's in that specific fund. Third, each fund keeps its own books, separate accounts, budgets, reports, and tracking systems. Finally, legal or donor restrictions must be followed strictly. Breaking these rules can lead to lawsuits or even criminal charges. These safeguards keep government finances disciplined and transparent.